Hello traders, welcome to this new weekly video. I've been absent recently in between the volatility of the market and also a little bit of skiing in between. I was not there available, but I'll try to catch up with you now. And this video is going to be talking about adapting to volatility. How do you adjust to the current market environment? And it's very important that we keep track of the nature of the market that changes, that evolves. We have different cycles and we need to absolutely keep track of that. And the one thing for sure is that we've been seeing a lot of uncertainty in the market, obviously mostly due to this massive geopolitical instability created by the Russian-Ukrainian conflict. We've seen over the past few months, inflationary pressures being built up, because from a downward trend, a massive bear market that we've had for the past 10, 12 years in the commodity sectors, and of 2020, we're starting seeing a big shift in most of the commodity sectors, being agricultural, energy, metals. This has created this massive inflationary uptick that we can see from country to country. On a personal basis, we can all see as consumers that we go to our supermarket, we're going to pay almost like 50 to 60% more expensive prices that we used to do a year ago. When we go to the pump, we've seen this massive increase in the fuel, and the energy problem has been even more marked right here in Europe. It's so close to the crisis, but at the same time so dependent on Russian energy, being crude oil, being natural gas. This has obviously also led the central bankers to reverse their monetary policy. Recently, we've seen the Fed this week rising 25 basis points and giving clear objectives that they're going to keep on doing that for the rest of 2022. We've seen the Bank of England and many other central banks around the world have basically taken that stance. And therefore, all these confluence of factors have created a new market environment, an uncertainty in the market, a volatility in the market. Now, how do we basically gauge that volatility? Well, we're seeing an increased range of price intraday, and that volatility has basically been felt by day traders, mostly intraday traders or even scalpers, if they haven't readapted to that market reality. Even traders that basically had the right trade from the start, or at least were on the right side of the trade, they're going to stop out because they don't adapt to that market volatility. I will basically take you through three main points that are so important. They should be applied in your trading on an everyday basis all year round, but they will make a massive difference, even more so if you are not doing it in these unstable times. First, you need to adapt your stop loss. Your stop loss should be also containing a measure of the volatility of the market or in the underlying instrument that you're trading. In my case, I've been using a mix of ATR and graphic technical points on my charts in order to basically place my stops. That basically means that no matter what happens to the market, my stop loss will reflect the underlying volatility of the instruments or the market that I'm trading. So if we're in a stable market environment where the market moves but not in a crazy way, then my stop loss will be a lot closer to my entry level. If we're in that sort of environment these days where you get big intraday range and the ATR has spiked up, then that means that my stop loss will be further away. It's not a bad thing. I know that a lot of people think having a stop loss that's far away is a bad thing. It is not. It protects your position from getting stopped out for silly reasons. Getting stopped out because of the simple noise of the market. And that's not what you want. You don't want to be stopped out for silly reasons. You don't want to basically put a position on the right side of the market, getting stopped out and seeing that market basically run up when you expected it to go right after that. That's really frustrating. And in order to basically deal with that frustration and that stress, that's why you need to keep your stop loss further away from your entry point these days. Wider stop loss, and this wider stop loss will automatically be part of your trading plan if they include a measure of volatility of that instrument that you're trading. The second point that I want to make is that because of the stop loss placement, which will be further away from your entry, that means that it will have an automatic impact on your money management and the size of the position that you're going to undertake. And I see too many times traders saying, I don't care, I take the same size of position, I use the same stop. And it can't be true, it can't be like that. If you're going to be trading biotech or energy stock these days, or cryptocurrencies, or if you're going to basically trading some major caps like the Teslas or the Facebook, you have to understand that the stop loss has to be adapted to the underlying stock or instrument that you're going to be trading. And therefore, you can't be using the same stop loss from one project to the other, from one stock to the other. The stop loss has to be adapted to its own underlying volatility. And likewise, the size has to be adapted to the current environment, because the current environment has created a volatility and bigger intraday range. That means that your position size has to be downsized. No one likes to trade smaller size. We always basically like to have the best value for our buck, but there are times where we need to downsize. We need to readapt to the market environment, and we need to readapt a notch down in order to be able to handle the stress, handle the volatility, and not being stopped out again because of silly market noise. And finally, the third point that I would like to make, you can make also and adapt your trade management. In my usual trade management, I've got several partial targets that I will take, along with some trailing stops that enable me to basically surf that wave as long as I can, to be in that trend, to enjoy the trend of that market as long as I can. So, for instance, in this market environment, more volatile market environment, I could decide that my first partial target, where I used to take maybe 25%, then in that case I will take maybe 40% or maybe 50%. Then you can be quicker, more proactive or adaptive to that market and take more initially. Secure your position at a break-even and let the market run in your favor if it does. If it does, then that's the cherry on the cake, and that's great. If it doesn't, then you'll get stopped out at break-even, and that's still a great trade because you printed green on your account. This readaptation of your trade management will definitely help you to face the increased stress of the market, and will help you basically also for your trading psychology to cope with the current market volatility. So in summary, in conclusion, 3 things that you have to basically change if you haven't got that in your trading right now. You need to adapt your stop loss. Your stop loss should be wider, and it should basically include the measure of volatility of the instruments that you're trading. You should be downsizing on your position size, and you should readapt your trade management position, maybe being quicker at taking the first partials and then letting a 10-20% of the remaining position ride out the market, try to basically surf that big wave and follow that trend. I hope that you found this video useful. I'm going to try to basically make these videos shorter but more effective. And if you have any questions, please, don't hesitate to comment, send me the question in the comment of the video. Hit that basically subscribe button. It really basically motivates me to do more of these short videos and to help out the community of traders out there. And I really do hope that I will see you next week. See you.